today we're looking at defense stocks. We know that NATO is increasing spending. We see all the unfortunate stuff going on in Ukraine with the Russian invasion. We're going to talk about Boeing, Northrop Grumman, Lockheed Martin, and Raytheon. Take a look at their dividends, take a look at the quality of the companies, their valuations. I'm going to tell you if I think they're good opportunities to buy right now for somebody that's looking for, potential a little bit more safety than the types of stocks that I own, and maybe some exposure to dividend and dividend growth stocks. The first one we're going to look at is Boeing. This is fast graphs. What we have on this end of the chart, and pretty much since 2018 and then going forward, we have a couple things. COVID happened, and then the challenges with the 737 MAX and the unfortunate crashes, and then the loss in earnings and revenue. And so what we can see is in 2019, earnings per share dropped 122%. And then in 2020, earnings per share dropped 570%. So what that meant was that they went from earning $11.69 a share in 2017, $16.01 a share in 2018 with growth of 61 and 37%, pretty strong, to minus 122 at negative 350 earnings, and then negative $23.30. Why is it like that? Well, they had to continue running the company. They had to continue investing. They had to continue with everything they need to run a company, and then some with the issues that they were having with the Dreamliner. And so the question now for investors is, what does Boeing look like moving forward, and is it a potential good opportunity? So what we can see is over this time frame, since 2002, the average price earnings ratio has been about 20. But what we need to do is take this period out, and we actually, in my opinion, need to take out this period in really 2018 as well, because it was so elevated. So let's take that out. And then I think we also need to take out kind of 2008. So that gives us about a 10, 11 year period where I think the price to earnings multiple was reasonable. And so we've got a price to earnings multiple of 17.5 on average over that time, with earnings growth rate of 8% over this time period. So if we go to forecasting, this is how we see what analysts are expecting earnings to be. And again, this is a tough one because who knows what's going to happen with their bounce back from the Dreamliner and COVID. But out through in 2023, they're expected $5.69 in earnings, and 2024, $8.38. And just for reference, that's much lower than the $16 in earnings that that's half of the earnings that they had in 2018. They really hadn't had earnings that low since back to 2016. What that tells me is like the demand, obviously, for aircraft and the other contracts that Boeing has is there. They just have to earn that back and get that back. But if we just look out through 2024, up to about that price to earnings ratio of 18, from here with what's expected, again, which a lot of unknowns, you're looking at a 4% annualized rate of return for a 10% total return. If that PE ratio gets up to 24, then you're looking at a 45% total return and a 16% annualized rate of return. And so if we hop over to Morningstar and get the rating from Morningstar actually gives Boeing a 5-star rating. They call it 41% at a discount to fair value. They've got a wide economic moat and standard capital allocation. And Morningstar calls out that their narrow body business is bruised after the extended grounding of the 737 MAX, but they anticipate that the structural tailwinds driving narrow body demand, particularly the development of emerging markets, will continue as the world emerges from COVID-19. As nations grow richer, their citizens tend to demand travel, and almost all aviation demand is served by two firms. We anticipate that Boeing will ramp 737 MAX production above previous peak levels over our 10-year forecast to serve global aircraft demand. Critical to our thesis is a normalization of U.S. and China trade relations, as management anticipates China will provide about a quarter of the growth in the aviation market over the next decade. So Boeing, a lot of risks there. The 737 MAX thing is something that, is a major issue, lost a lot of trust, but they're such an important contractor and provider that not too big to fail, but too important to fail almost. And I think there's actually a decent opportunity in Boeing, which I never thought I would say. And so Boeing doesn't pay a dividend right now. They cut it, but it was a pretty decent dividend growth company through 2018. They grew it all the way up from, it's hard to tell, but it looks like this was around 50 cents, all the way up to over $8 a share in dividends, it looks like. Okay, Lockheed Martin is a little bit easier to look at just because they have a lot less, we could say, volatility, right? And just off the bat, love to look at this. Over the last 20 years, Lockheed Martin has compounded at 12% per year compared to the SPY at under 7%. And then they've grown the dividend at over 17% on average per year for the last 20 years. So what that looks like is a $10,000 investment. You've actually made back $19,000 in dividends, made $88,000 in growth of the stock price, coming to an annualized rate of return without dividends of 11.25%. When you add it all together, that's $108,000 in a 12.35% compound annual growth rate. So turning $10,000 to 100, that's a 10x return in 20 years. This is what's amazing about dividend growth and investing in dividend growth stocks. So if you would have invested $10,000 into Lockheed Martin in 2002, you would have gotten 44 cents per share in dividend. You would have received $93 in dividends on that $10,000 investment. That's just under 1% per year, your yield on cost, yield on your cost of shares. Fast forward to 2021. The dividend per share in 2021 was now $10.60, up from 44 cents per share in 2002. And on that same $10,000, you would have earned $2,242 in 2021 versus $93 in 2002 without adding any more money. This is just letting it grow. And so that means that if you held the stock that long, you are now getting a 22% yield on the shares, the share price you bought shares for in 2002, which is just amazing. And it's the magic of dividend growth stocks. So even though Lockheed Martin's dividend is only 2.67%, if you've held shares long enough, you are earning 22% yield on your cost of shares 20 years ago. That's what's attractive about dividend growth stocks. We see that it's traded at a normalized price to earnings ratio of about 16 over the last 20 years. We saw some period of time after 2008 where Lockheed Martin had some issues. There's maybe a lawsuit going on or budget cuts and defense here. I'm not exactly sure, but it traded at below a PE of 10, 11, 12. And so that's actually bringing its normalized PE down. And then it traded over, it was overvalued for a little bit. And so it's, bounced back and stayed kind of in line with this blue line, which is its average PE. What we can see is only a couple times has it gone below this PE ratio of 15. It looks like after the great financial crisis, didn't get back up to it until 2014, came down and hit it in 2018, dropped below it in 2020, but then since then it's stayed above it. And so right now it's not super cheap, but it's certainly not excessively valued when we think about its average PE ratio and the fact that it's almost trading in line with its PE of 15. And so if we just look out a couple years, even to a PE of 15, which is a reduction from the PE of 17 right now, you're looking at a 15% annualized return through 12/31/2024 for about 6% annualized. If it trades up to its average, then you do a little better and you get up to about 7.7% annualized for a 21% total return. And when you think about it, like the security of this stock, the fact that the company's not going anywhere, they're going to be as relevant as ever in a new age, unfortunately, of increased defense spending. Not a bad opportunity if people are interested in that. If we take a look in Morningstar, it's only 3-star rated, and that's just going to be because they don't think it's too far below fair value. Yep, they think it's trading in a range that they consider fairly valued. A wide economic moat. You'll see that with these defense contractors because it's so tough to come in and disrupt these. And the headline is just that they think Lockheed Martin's exposure to the F-35 program, hypersonic missiles, and the militarization of space is well aligned with areas of secular growth in the defense budget. For instance, the F-35, which accounts for 30% of Lockheed's revenue, will be maintained through 2070. So, pretty reliable revenue stream there. Moving over to Simply Safe Dividends, one of my favorite resources for dividend stocks. We could see it's got a 2.68% dividend yield, a little bit above 5-year average, which means the stock price is either lower or the dividend growth has been higher than normal. That's how it's gotten up higher. Very safe dividend, 84, a 7.7% dividend growth in September of 2021. They've got a 40% payout ratio, which they rate as low for most companies. Debt's looking pretty good. Their net debt to capital is a little bit high, 64% for most companies, but I think they'll be all right. Dividend streak, 21 years without a reduction. This is what people that invest in dividend stocks love. They increased their dividend from 2007 to 2009. Their recession sales only dropped 1.2%, which makes sense. They're recession resistant. That's why we're looking at these stocks right now. And their return was minus 46%, which was actually better than the S&P 500. So their latest dividend increase was 7.7% in September 2021. Last 5 years, they've averaged 9% per year. In the last 20 years, 17% per year, which is rated as very fast. 19 years of consecutive dividend growth, 21 years uninterrupted dividend payout. Next up, we have Northrop Grumman. So Northrop Grumman actually looks a little bit overvalued compared to its average price-to-earning ratio over the last 20 years. It also has outperformed the S&P 500 with a 12.7% compound annual growth rate compared to just under 7%. And if we kind of do the same thing we looked at when you first invested back in 2002, you were getting about a 1.6% dividend yield on your shares. If you held those shares all the way through 2021, you're now getting 13.7% per year. That's every year, 13.7% on your shares. Is a 13.7% return on your shares just from the dividend from the shares that you own in 2002. And if you think about just reinvesting and adding and buying shares over time, makes an argument for me to just stop doing all this crazy growth stock stuff and find the best dividend payers and own them for a long time. That $10,000 investment, this is what it's replicating back in 2002, has turned into $115,000, earning $12,000 in dividend income, $103,000 in growth of the share price for a 12% annualized return without the dividend. In total, $115,000 comes out to be a 12.7% return with the dividend. Dividend growth rate over the last 20 years, 11.44%. Yeah, and this makes sense. So Morningstar, we saw that Northrop Grumman looked a little bit overvalued. Morningstar's got them as a 2-star. Nothing against the company. They just simply do it based on fair value, and they have it trading at a 28% premium. Wide economic moat, standard capital allocation. So same thing there. Simply Safe Dividend, so 1.49% dividend yield, lower than Lockheed Martin, 80, dividend safety rating of 80. They announced a 10% dividend growth in May of 2022. 25% payout ratio, low. 27% forward payout ratio, debt looks good. 32 years without a reduction in dividend. They increased the dividend during the recession. Their sales did drop 14% from 07 to 09, minus 55%, which was in line with the S&P 500, so performed a little bit worse than Lockheed Martin. 10% dividend growth in May of 22. Over the last 5 years, 12%, and then 20 years, 11%. If these numbers are different than fast graphs, it's just a little bit different in the way that they measure them. 18 years consecutive growth, 32 years uninterrupted. And if we go back, to 2012, really the last 10 years, their earnings growth rate has been 12% per year, coming to that normalized PE of 15. And right now it's at a blended price earnings ratio of 18. And their earnings growth is actually not, as of right now, forecasted to be increasing. It's actually forecasted to slow down compared to its really 2013, 2014, 2015. And so maybe not as good of an opportunity as Lockheed Martin, at least at this point. But let's jump to our next stock. And so Raytheon, this one, you can kind of just see it from the line here. But this, I think, might be the most interesting opportunity out of these, other than Boeing. But Boeing is higher risk because of all the execution stuff they've got to figure out. But if we're just looking, it's trading at a price earnings ratio of 20, but with pretty strong earnings growth expected, 12%, 22%, and 15% for the next 3 years. And on average, they've grown at 11% over the past 10 years. So right around 11% over the last 20 years as well. And so if we take that out, I mean, just to the PE of 15, which would be down from 20 right now, you're still looking at, even with that reduction in PE, you're still looking at 13% total return and 5% annualized through 2024. But this blue line is what its average has been, which its average would be 27. So pretty high, but when their earnings are expected to grow 12, 22, and then 15%, is it completely unreasonable? No, probably not. But maybe, more realistic would be to look at, say, around 20, 22, 20, 24 or something like that. So this is showing the same thing, earnings expectations, but just gives us the ability to go to a lower price earnings ratio. So if we think they're going to stay at their current PE, which is right around 20, you're still looking at a 16% annualized rate of return through 2024. And then if they happen to be at a PE of around 23 in 2024, it's almost a 23% annualized return for 68% total. And at a PE of 24, which is not out of the question for what it's traded at historically, you're looking at an 80% total return and 26% annualized. And so for Raytheon, they get in line with kind of fair value from Morningstar they've got the fair value right around 94, a wide economic moat and standard. And jumping over to SimpliSafe dividends, 2.3% dividend yield, a dividend safety rating of 70, which is still safe, not as safe as Northrop Grumman and Lockheed Martin. Almost 8% dividend growth, which was announced in April of 2022. 45% payout ratio, which is a little bit higher than the other two, but still low. Net debt to EBITDA, net debt to capital still is low. Last thing we'll show here is I forgot to do this is back to fast graphs looking at the previous performance since 2002. It's grown at compound annual growth rate of 9% per year compared to just over 7% for the SPY. And so performance not as good as Northrop Grumman or Lockheed Martin. Total dividends, $12,000 over that time. Growth of $48,000 for an annualized rate of return without the dividend of 8%. $60,000 total growth on that $10,000 investment for that 9.2%. And the average dividend growth rate over that 20-year period is 10.8%. And so here's a quick just kind of rating of these companies. We've got Raytheon, Lockheed Martin, Boeing, Northrop Grumman. Really not paying attention to Airbus or General Dynamics, just my preference. Maybe I should. We've got Raytheon rated as a strong buy by their quantitative score on Seeking Alpha, a buy according to Seeking Alpha authors, and then a buy according to Wall Street. When we look at it compared to Lockheed Martin, Boeing, and Northrop Grumman, it's got the strongest ratings across the three. It is rated number 1 out of 60 in the industry. Lockheed Martin's number 7, Boeing's number 34, and Northrop Grumman is number 8. The forward yield, 2.3% compared to 2.67 with Lockheed, none for Boeing, and 1.49 for Northrop Grumman. So Raytheon and Lockheed Martin kind of right there hand in hand. Raytheon does have the lowest dividend growth rate out of Lockheed, Northrop Grumman, and Raytheon. 22 years of consecutive dividend growth according to Seeking Alpha, 20 for Lockheed Martin and 17 for Northrop Grumman. And then on a price to earnings basis, right, if we look out 1 year, Raytheon's at about a 19, Lockheed Martin's at 15, and Northrop Grumman's at 18. But then when we factor in its growth, its earnings growth, and we look at 2 years and 3 years forward, Raytheon's trading at about 14, Lockheed Martin's trading at about 14, Boeing, because of that expected bounce back, is at about 16, and Northrop Grumman is at about 15. And then if we just kind of take a look at performance over the last month, Boeing is actually the best performer. It's bounced back a little bit, but then if we zoom out 3 months, Raytheon's down 7%, Lockheed Martin's down 6%, Boeing down 25%, Northrop Grumman up 2%. And then let's go to year to date. 9%, which is much better than the rest of the market, really. Lockheed Martin, 18%. Boeing, down 30%. Northrop Grumman, up almost 20%. Over 3 years, shares of Raytheon up 15%. Lockheed Martin, up 16%. Boeing, down 62%. Northrop Grumman, up 44%. 5 years, 22, 49, minus 30, and then 80. So 10 years for Lockheed Martin, up 390%, Northrop Grumman up 646%. And crazy, Boeing is even up almost 100% over the last 10 years, with Raytheon just barely outperforming that. And so, over the long term, the stronger performers are Lockheed Martin and Northrop Grumman. It looks like Raytheon is potentially a better buy right now, but maybe Lockheed Martin and Northrop Grumman have a better, history of execution and performance, and it makes it worth it to pay up. So just looking at the numbers, I was thinking Raytheon is the better opportunity right now. But really, I think all of these are pretty good opportunities. Obviously, I don't own shares, so as I continue to explore these, I'll share whether or not I end up purchasing shares or not. If somebody wanted exposure to these defense stocks or industrial stocks in general without the single stock risk, the XLI ETF is an ETF that anybody can buy. It's got a yield of 1.68%. The expense ratio is 0.10%. Its performance year to date down 10% over the last year, down about 9%. Over the last 3 years, it's averaged about 11% per year, pretty decent. 5 years, about 9%. 10 years, almost 13%. And then since inception, which was 1998, 8.2% a year. And that would just get an investor exposure to these stocks that we talked about, but also some more industrial type stocks if that was what they were interested in. Raytheon is about 5.5%, Union Pacific, the railroad, 5.3%, UPS, 5.3%, Honeywell, 4.8%, Lockheed Martin, 3.9%, Caterpillar, 3.9%, Deere, 3.4%, Boeing, 3%, 3M, 3%, General Electric. So that's an option there if somebody just wants exposure to the industrial sector and some of these defensive stocks without the individual stock risk. Would love to know if you own any of these in the comments. Do you want me to review any other dividend stocks? I kind of want to take a look at Deere. I kind of want to take a look at maybe a deeper dive into Boeing and see. That one seems to have the most turnaround potential, but also the most kind of execution risk. So again, just thanks for stopping by. I hope you're having a great day. Investing is a beautiful thing. It's so amazing we have the opportunity to even invest. And it can be scary out there, especially in bear markets. So I'm just trying to provide some education, some information, and some positivity in this world.